Hello everyone. Today I am going to provide you with an overview of MCX natural gas view which we have shared last week, and thereafter we will at the end we will be giving a focus over how natural gas looks like at current levels and how it can pan out in the coming week. So this generally we publish a weekly report giving an broader outlook about different MCX counters. In respect with natural gas, last week it ended at 660 odd levels, and we have given a view of upside capped. As we can see here on the charts, we were expecting that this counter should retrace back towards lower levels from the highs of 675 to 700 mark. And this, as we know that natural gas is a high beta counter, in the worst case scenario, we were expecting that it can reattempt towards the previous highs. And from those levels, again, it will be expecting drifting down towards support levels. So overall, our bias was that upside is capped, trading in overbought zone. The counter should not manage to hold over and above these levels, and over a period of time, it should reattempt towards lower support levels. As per our write-up, what we have mentioned is going forward for the coming week, technically pullback towards 675 to 700 can be looked for contra trading shorts with strict stop losses. Overall, initially we can assume a broad range between 550 and 750 levels, initially with sell on rise and buy on dip. That means we were expecting that this counter should initially find some resistance at around 675 to 700 mark. In the worst case scenario, the pullback can stretch towards 750, and on the lower end, it will be attempting towards retesting of 550 odd levels in days and weeks to come. In line with the view, as on 27th of July, when natural gas moved towards 700 mark, we initiated a bearish strategy. But since we are aware that natural gas counter is a high beta counter, and we are going against the momentum, because as per the price study, we have not seen any kind of reversals on charts. Thus, we have chosen the conservative strategy on a bearish side. So we initiated hedged stock short strategy, where we have sold future, and along with it we have sold at the money 700 put at rupees 78 rupees. So the bias was that over a period of time, even in spite of volatility and pullbacks towards high levels, we will expect natural gas to drift down below 700 mark. In this scenario, we have initiated 1:1 risk reward ratio, and the break even was at around 778. That means if the expiry of August is even towards 7788 mark, we would not incur any loss. Losses would have been over and above this break even point. So, in line with the view, we have seen that natural gas initially on Monday and Tuesday witnessed a high volatility, and it bounced back towards the highs of 760. That was it's close to its previous highs against our view, but thereafter it failed to sustain over and above those levels, and in next three trading sessions it slipped down almost 16% from highs to the lows of 640. In between, we managed to capture the profit, and we booked partial profit at around 652 odd levels in natural gas, and we managed to take a profit of around 38,000 per lot as on 28th of July. That is just after a session we have initiated this strategy. We booked partial profit and we are holding rest of the profit. As per the payoff diagram, we can see any expiry of August series below 700 mark will be profitable, and the maximum profit in this strategy is 98,125 rupees per lot. So since we have booked partial profit at 38,000 mark, even if this counter manages to close over and above 778 levels, that is a break-even level, we will not incur any kind of substantial loss. We will still be in a profit because we have already taken a partial profit of 38,000 mark. On the flip side, if the closing is below 700 levels, or in between, if it slips down towards 600 and lower levels, we can gain much more profit than the current profit which we are getting. So the maximum profit can be at till 98,125 rupees per lot. So it's a decent profit. We are holding up the rest of the positions after taking part profit. Now going forward, if we see for the coming week, natural gas which ended last week at 640, still the bias continues to be range to down. If you see the chart, this is a daily chart. Natural gas is still trading in overbought territory. As per the price study, it has formed a kind of hanging man pattern candlestick. on daily charts, and which is a negative candlestick pattern, and we believe that over a period of time, the support of 640, which is an important level for this week, will be taken off, and natural gas can retest the support levels of 540 in days to come. So initially, if there is any kind of pullback from the support and crucial level of 640 towards 700 odd levels, we can look for reinitiating short positions once again. And once it sustains below 640, we believe that the selling pressure and profit taking can intensify, which can take the counter toward the supports of 540 odd levels, which is an important support on a midterm time frame. So overall, the bias continues to be range to down, pull back towards 700 odd levels. Can we look for contra trading shorts, keeping a stop of 720 odd levels on the closing basis? Since this counter is a high beta counter, we prefer to go into the strategies in order to skip the volatility and losses which can incur because of not being hedged. So we should look for hedged strategies in natural gas, and through that hedge strategy, we generally buy time from the market, and the probability of being right turns out to be high. So this is the view about natural gas. Thank you, viewers, for your precious time. If you find our content relevant, then kindly get in touch with us with your queries. Along with that, you can also ask for latest research reports and the trading ideas. You can contact us at the given email ID and the contact details. Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.